Hi everyone, welcome to another Honeystocks.com stock market outlook video. This video will be going out on the 15th of October 2022. Now before I do the usual and switch over to my screen share and walk you through many of the charts and the data that you all tune in for, I've had a lot of nice emails and messages after the work that I've been putting out over the last few weeks. I know that it's helped many of you. So I just want to extend some thanks and gratitude for that. Now, the last week has been incredibly challenging. We had some CPI data during the week, and we had the fifth largest intraday move from a 52-week low in the S&P 500, and we had the fourth largest intraday move in the Nasdaq Composite. So it's been a very volatile week. Albeit we have moved off the lows. Now that data has been taken from Sentiment Trader, and going forward I'm now starting to look to the charts and what could potentially come next. Now, as you all know, I do not use any magical hindsight indicators. I timestamp all of my work, which is very, very important for the field in which I work. And although I use technical analysis primarily, I just want to be very, very clear that I am not a short-term day trader. There are plenty of day trading gurus all over social media who will happily take your money. For me, my approach is more mid to long term with a heavy emphasis on risk management. Now, really, I'm looking for trending markets. I'm looking for rebound levels in the market, which is where a lot of my work has really been focused over the last couple of months. And I think you'll probably get a lot of value from the charts and the data that I'm about to walk through. Now, there's a lot of headwinds for stocks at the moment. There's a lot of macro headwinds. And everybody really wants to know if there's any light at the end of the tunnel, and could we potentially get a 19% bear market rally like we've seen in June. Now, a few of my recent time-stamped calls, as I called the start of the market crash at the beginning of the year, I called the bear market rally in June, the recent top in August, and we could go all the way back to the crash of 2020 as well. So if you do get some value from my work, please do like and subscribe on YouTube, and feel free to also follow me on Twitter as well. But very, very important disclaimer, do all your own due diligence, don't be silly, and of course, as most of you know, I am working towards my CMT. So enough about me, let's dive into some charts, let's see what the market's telling us. Now, I would like to start off with this chart, which is a chart that shows major lows by month in the S&P 500 since 1932. Now, as we can see from the chart, October tends to be a month where we should be paying attention for bear market lows. Now, of course, the market landscape is incredibly challenging at the moment. We also have to deal with the market sentiment. We're looking at things like the fear and greed index, which tells us that there's extreme fear in the market at the moment. Now, I know that many investors like to use the fear and greed index as a contrarian signal. For me, it's really just a supplement to price action and what price is ultimately telling us. There's a lot of words going about at the moment. I think many have probably seen the words like capitulation and what capitulation looks like. And of course, we all know, hopefully we all know, that capitulation describes the dramatic surge of selling pressure in a declining market. Now, my work got a lot of attention this week because of a couple of charts that I put out in my weekly letter, which, if you haven't subscribed to my weekly letter, you can do so. It's completely free on the website. Now, many of you will have seen this. This is from the textbooks. It's just a very simple chart showing the sentiment of a market bubble and what a bubble popping looks like. Now, if we jump over and we compare that textbook chart with the current present day S&P 500, we can see that the textbooks are calling this to perfection. Now, this has been the chart since the COVID lows back in March 2020. Now, the big question everybody has at the moment, well, if the textbooks continue to play out, where are we in the cycle? Now, of course, we can see that if we were to get capitulation followed by despair, then that's not a good look for the markets. Now, for me, the 200-week simple moving average looks to have quite a lot of merit there. We can also add in the 50% retracement from the COVID crash lows. I think below 3,500 in the S&P 500, I think we probably start to see words in financial media like capitulation, etc. Now, what would capitulation ultimately look like? Well, if we look at Michael Burry from the Big Short, I'm sure most of you have probably seen the movie. Well, Michael Burry has gone on record and he thinks that we head towards these undercut the COVID crash lows again. Now, this is a chart that I have communicated multiple times over the last few months, and of course, if we do start to see breakdowns in the S&P 500 below key levels, 3,500, these bearish targets, although they do seem quite extreme, they don't seem like they are out with the realms of possibility. Now, I do have quite a lot of charts that I want to walk through. This will be a deep dive into the broader market, quite detailed. As always, I will have a few individual charts that I will go over at the end. For disclosure, these are the charts that were recommended to our clients and members last weekend. There were buy opportunities and short opportunities. These are the actionable charts, and of course there will be a couple of these that I will be walking through as well, just to show the methodology. And for instance, the stocks that are obviously moving higher might still be appealing to many of you. But let's have a look at the US dollar index and the volatility index. Now, as we can see from the chart, there is a very strong correlation between volatility and the US dollar recently. Now, of course, what we should hopefully know is that when the dollar is rising, the volatility is rising, which means stocks are, of course, going down. So in order for the market to get any kind of sustainable rally, in my opinion, what the charts are telling me is that we need to see the US dollar index start to cool off a little bit from the current levels. Now, when we look at the longer term US dollar index, we can see, and this has been my chart for months, the 120 level is a level that I have as my bullish target on the US dollar index. Now, of course, there are going to be pullbacks along the way. I have been highlighting this RSI level in the US dollar index on the monthly as a level to keep an eye on for some kind of pullback in the US dollar index, which again would hopefully result in some kind of bear market rally. We haven't really seen that yet. We had a massive 19% bear market rally back in June. But ultimately since then it has been slim pickings for bulls. There have been charts going higher, let me be clear about that. But if you're looking at the S&P 500 as your gauge and your metric, etc., then you do want to see the US dollar index start to cool off. Now, I find it quite interesting that this week the put call ratio has actually fallen off a little bit. Of course, this is just one of many data points that I like to use when gauging whether or not we could get some kind of rally. We know that the yield curve is inverted at the moment. We know that when the yield curve inverts, it is a precursor to a recession. These shaded areas are periods of recession. We can see back in 2000, 2006, and of course just before COVID there was a slight inversion. But interesting to me, the yield curve is now pushing up, pushing down against the levels back in 2000, which of course we're looking at dot-com bubbles at that point. So the yield curve is continuing to get worse. It's not getting better. So that's not a positive sign for the markets. Now, when we look at individual charts and we are using the major averages to really gauge what comes next. I've covered the Russell 2000 a few times recently, just highlighting that there is a support level in place there with a bullish divergence. Now, for me, I'm using the bullish divergence. I'm giving it minimal weighting at the moment. I think what I do understand is that the more times a level is tested, the more likely it is to break. I do understand that the risk to reward proposition at these levels probably favours a bullish position. The reason I say that is it's very easy to get out. You can have a stop loss just below these levels and have a bullish position. And of course, if it does break down, then very easy out in the market. We've got the Dow again is hovering around the 200-week simple moving average. Now, in my weekly letter that I put out during the week, I did highlight that you should use these moving averages as not hard levels in the market, rather they are areas of interest. Price will happily oscillate between the two, above and below the 200-week moving average. It doesn't mean that if we go below 297 that the market is a complete short. The market can absolutely rebound from these levels, as history has told us. So we are at a very big level, I think, with the Dow. I think it's mirrored with the triple Qs, of course, big tech. We've got the mid caps. Again, I am probably expecting a test of the COVID crash levels here. Again, very, very similar to the Russell 2000. The mid caps do have a slight bullish divergence. But again, I think there has to be some kind of shift in sentiment and media narrative, etc., for some kind of bullish catalyst. We've got, again, the micro caps, almost identical to the small caps and the mid caps. Big level. And of course, we've got financials who, obviously, JP Morgan, etc., started reporting today. The earnings to me looked quite reasonable, but again, the financials are absolutely front and centre at the moment. I think the big concern would be is if we get a breakdown in the financials, how would that impact the broader market? And of course, it's not just the US markets, the world, the global markets are at very big key levels at the moment as well. The All Country World Index, as we can see, is back to the levels dating back to 2018. Again, I am noting a very slight bullish divergence. Now, I am going to cover some individual stocks now. But what I would say with the charts that I'm about to walk through, these charts are subject to change. I am recording this with around 30 minutes left in the markets on Friday. Whether these charts collapse or rally into the close, I have absolutely no clue. But what I think makes a lot of sense is if these are charts that you like, please do all your own due diligence. I will change my thesis on 30 seconds notice as soon as the markets tell me to. But I think there's a very key level here. I think if there's a breakout above that 250 level, Netflix today announced their new subscription for ads, an ad-supported subscription, and the market has initially this morning, the Netflix stock was showing really good relative performance, but as the day has progressed, like everything, it's not been immune to the sell-off. But I think that the chart is in a sideways range at the moment, and I like Netflix above 250. Now, we did have semiconductors catch a bid from logical levels on Thursday. This is a chart that I've been keeping a very, very close eye on, because I'm sure most of us are looking at the semiconductors and very attractive stocks at very good prices, but of course we need to see some kind of bullish price action. I think with the semiconductors, I think there's a risk to reward proposition for longs above 169, but very, very mindful that if the S&P 500 breaks below these key levels, semiconductors are not going to be immune to that. So, managing risk is absolutely key. Taiwan Semiconductors, again, back to the scene of the COVID crash. Again, reported earnings. For me, the earnings looked pretty decent, but again, need to keep an eye on these levels. I think risk to reward favours a long position, but absolutely, if it breaks below, then it's a big problem, and you'd probably be looking to maybe have some protective puts or something in that scenario. Very, very similar to Nvidia. I think that's a big level for Nvidia. We've got Amazon. Now, a lot of the charts I'm focusing on support levels, because these are stocks that I am personally looking to buy. I've been very, very fortunate this year that the US dollar has absolutely ripped against the British pound. So I've been paid to literally just hold dollars all year. So these are stocks that I'm looking to buy. I think Amazon, if it drops to around 100, I think that's a level that might be of interest to many. I think Tesla is actually starting to show a little bit of weakness here going into the close. I did just post this chart a short time ago to Twitter, and of course it's not looking particularly strong at the moment. I do like Tesla. I actually test drove one of the cars a few weeks ago, and for me, if it starts to break below these levels, I think that's a big problem for Tesla. Given the market cap and the weighting in the S&P 500, I think you probably want to see that level hold up. Again, very, very similar with Apple. Want to see this level at around 130 hold up. Now, some of the charts that might make sense for some of you that like to bet against the market as well. A lot of my work has been focused on market direction over the last few months. Recently, there have been some individual charts that have gone out. I disclosed them at the start. So just want to show that with something like Trade Desk, I'm not looking to rewrite any investment books or anything like that. Very, very straightforward for me. I'm looking for really high valuations, high PE ratios, and negative earnings growth. I think these are the types of stocks that are not going to do particularly well in a prolonged bear market, if that's ultimately what we get. And last week we recommended this as a short below 55. Now, whether you're outright shorting or using put options, whatever your deal is, I think any rallies into that 56 level, if we get a sell-off from that, then that would be a potential catalyst to go short. Now, word of caution on going short in the market. We can oftentimes see the worst companies rally 30-40%. We've seen it back in June. So although, in my opinion, these are companies that are not particularly great, it doesn't mean that they can't rip 30-40% higher in a matter of weeks. So, of course, risk management is absolutely key. I don't like to personally outright short. I prefer put options because you can easily define the risk. Credit Suisse, again, has got a lot of airtime over the last few weeks. Last week we recommended a short on any rally. Of course, hindsight tells us that it's started to move lower, but we will need to see what happens next week. I don't know if it gets much airtime in the US and Canada, in Asia, which is where a lot of my audience is based, but Europe isn't doing too well at the moment, and of course Credit Suisse has been declining, but it wouldn't surprise me if this is one of these names that will rip 30-40% despite how bad the company actually is. We've got ExxonMobil, obviously in the energy space. Now, just to be very, very clear on this, the energy sector has not even broken out yet. Now, that will be maybe a surprise to many of you that don't follow charts, because the performance of energy over the course of the last year has been unbelievable. But if we start to see stocks like ExxonMobil break out above these levels at 105, then of course that is a big bullish catalyst, in my opinion, for the energy sector. Now, just a quick note, if you are still here, please do hit the like button. Feel free to subscribe. As most of you know, I do not upload to social media nearly enough to really get noticed by things like YouTube algorithms, etc., etc. So if you do hit the like button, it would be much, much appreciated. I put a lot of hard work, as you can see, into my craft, and it would be really, really appreciated if you hit the like button. And of course we have Roku, again, one of the charts that was recommended last week to our clients and members. Just very, very basic, 50-day simple moving average, and of course it's been selling off with the market. Again, in my opinion, high PE ratio, and of course negative earnings growth. But that carnage started way back in July 2021, running to very basic overhead $500 round number resistance, and it's just been selling off ever since, which again is something that I highlighted way back in July, just for clarity. But yeah, if you have just stumbled across my work for the very first time, feel free to go and check out our website at Honeystocks.com. We provide various membership options, monthly, quarterly, annually, and we provide our premium work to our clients and members every single weekend. We provide a midweek halftime report, updating thoughts and charts on the broader market. We provide investment ideas, which I'll show you what that looks like in a second. We provide access to a wonderful community, provide access to all of my chart books. I don't just cover stocks, we cover all the major liquid ETFs, provide currencies, global markets. Our chart book is very, very extensive, and also if you are somebody that's maybe looking to learn a bit more about technical analysis and maybe building a process, I'm told that my technical program, which I include completely free with all memberships, is very, very good for helping you to build a process. But just to show you what our high conviction ideas look like, ConocoPhillips, massive winner this year. Netflix, again, good winner. The steel index was a good winner. Commodity index, again, one of our shorts that we put out a few months ago, was a massive winner. Zillow was a really good winner. Box was a massive winner. So we are very, very flexible in our approach, both long and short, but it's really a quality over quantity approach that I have. I've got a very professional setup. I've got a community, it's not alerts via WhatsApp and all that crap. It's a very, very professional setup that I have, but just to show you, some of our, I understand that not everybody has massive accounts, to this degree, but these are our recent wins for one of our clients and members who went with shorts in the market and did very, very well. But I'm very, very unique in what I do. I log for complete transparency every single high conviction alert that's ever gone out on our website. So purpose of that is just to show you the dates and how those stocks have gone on to perform. I've done that since I started back in 2019, 2018. But I think if you are someone who has a mid-term approach, weeks to months, maybe you are just too busy with work, family life, and maybe you're sick of hunting around social media every week and you'd like to be part of a community and have access to a chartist who has a reputation for getting the big calls correct, then feel free to go and do your due diligence. But if you have stuck around to the end, thank you very, very much for watching, and don't forget to hit that like button. Thanks as always.